Hello, I'm Julie Price, and welcome to Juniper's second quarter 2021 economic review. Following a challenging 2020 and start of 2021, there's finally light at the end of the tunnel. As we enter the second quarter, the economic landscape is dominated by two surges, a fiscal surge and a vaccination surge. On the fiscal front, the $1.9 trillion American Rescue Plan is estimated to provide $1.2 trillion in additional spending to the economy in just the next 6 months, with most of the money going to low and middle income households who have a greater propensity to spend. On the vaccination front, the U.S. has made considerable progress with its rollout efforts, with total doses administered climbing to over 100 million and rising at a pace of close to 3 million per day. I myself have just received my second dose, and I'm looking forward to meeting with clients in person again. The U.S. vaccine rollout is paving the way for an end to the social distancing recession and the long-awaited reopening of service sector businesses, factors that very likely will lead to a powerful pickup in GDP growth in the second quarter and later in 2021. The months ahead should provide greater clarity around the pace of global recovery, the duration and extent of further fiscal support, and sustainable valuations, particularly in the U.S. equity and fixed income markets. Many of us are beginning to wonder how long a dovish Fed can stay on the sidelines and what this may mean for a low interest rate environment going forward. This quarter's economic review starts with an update on the course of the pandemic. I'll then discuss the pace of recovery, considering trends in economic growth, jobs, profits, and inflation. Then I have some comments on fiscal and monetary policy. Finally, we'll consider the implications for our investments in U.S. fixed income and equities, as well as international equities, which continue to support the need for a diversified portfolio. Join me while I discuss these topics using materials from the experts at J.P. Morgan. Any discussion of the economic and investment outlook must first start with an understanding of where we are at with defeating the pandemic itself and the light at the end of the tunnel, herd immunity. The left-hand side shows that we have made considerable progress with both confirmed cases and fatalities plummeting since the winter surge. This begs the question, where are we on the road to herd immunity? The right-hand side uses blue to estimate immunity from infection, green for those who have received at least one vaccine dose, and gray for both. At the end of March, we see a total of 55% as we near the range of the 70 to 80% that experts have suggested could represent herd immunity. So over half the population has some level of immunity, which is incredible progress. J.P. Morgan estimates that the number will be 65% by the end of April, 75% by the end of May, and 85% by the end of June. They also mentioned a recent poll asking participants if the vaccine were free and available to them today, would they get vaccinated? Of which 74% answered positively. Granted, the challenges with variants and the vaccination of children remain, but still very good news on the pandemic front. This slide shows the impact of the recession and fiscal stimulus on the federal budget. Over here, we see total spending for 2021 at $6.9 trillion, which includes the most recent $1.9 trillion American Rescue Plan in the other category. The revenue used to fund the spending includes 50% borrowing, up from 35% last quarter and 22% at the end of 2019. The last administration deficit spent, and the current administration is deficit spending as well. Looking at the Congressional Budget Office's February projection as a percent of GDP, they also include the recent $1.9 trillion stimulus. However, they are likely an underestimate for 3 reasons. First of all, it excludes the potential cost of the Build Back Better infrastructure plan, estimated at another $2 trillion, as well as student loan forgiveness. Secondly, they also assumed the individual tax cuts contained in the 2017 Tax Cuts and Jobs Act expire on schedule at the end of 2025. Third, they assume a continuation of very low long-term interest rates even in the midst of an economic recovery and huge deficit spending. A more realistic view would be that we hit a new record high debt to GDP ratio by the end of fiscal 2021, even higher than the aftermath of World War II. Although I don't believe this will result in a fiscal crisis in the next couple of years, a failure to rein in deficits and borrowing could lead to significant problems. As I've been discussing for the last few quarters, a sharp rise in inflation could result in higher interest rates and higher taxes and could ultimately set the stage for an economic relapse. Following a collapse in the second quarter of 2020, economic growth surged in the third quarter and had a moderate rise in the fourth quarter. Despite this initial strong surge, economic activity remains far below the trend we've been on since 2016. This really reflects the many sectors of the U.S. economy that cannot fully reopen, including travel, leisure, entertainment, and restaurants. With the pandemic lessening and new fiscal support, the economy is poised for a surge over the course of 2021. JP Morgan predicts GDP growth of 4 to 4.4% for first quarter 2021, 10% for second quarter, and 8% for each of the third and fourth quarters, totaling 7.7% year-over-year growth. This should push the economy nearer to a full recovery, getting much closer to this trend line. This slide illustrates the 22 million jobs lost between February and April 2020 before recovering 12 million jobs, or 58% of the total loss between April and November. While this partial recovery in the labor market is certainly welcome, the pace of recovery has slowed, with the February unemployment rate coming in at a still elevated 6.2% and now March a little lower at 6%. Much of the remaining unemployed are workers from shuttered sectors I mentioned, like leisure, hospitality, travel, retail, and food services, as well as state and local government cutbacks. And this does not include the almost 4 million people who have dropped out of the labor force and are not counted among the unemployed. However, as the service sector rebounds strongly in late 2021 and early 2022, JP Morgan expects very strong job growth and an unemployment rate falling between 4.5% and 5% by the end of 2021 and to between 3.5% and 4% by the end of 2022. The deep recession in the economy was mirrored by big declines in the S&P 500 operating earnings in early 2020. However, earnings have recovered substantially since then and now look to set a new all-time high in 2021. This is partly due to sectors like technology, communication services, healthcare, and consumer staples seeing few negative impacts from the pandemic and, in many cases, saw stronger revenues. The thin party lines in the Senate and House also suggest that President Biden may not be able to implement the tax increases on corporations that were in his pre-election plans, which further makes the case for strong earnings in the short term. However, fiscal pressures like the upcoming infrastructure bill may lead to tax increases later in the decade, and this, combined with rising wages and higher interest rates, should lead to a sharp slowdown in profit growth at that time. The onset of the recession, combined with the collapse in oil prices, triggered a decline in already low inflation. We measure inflation using headline CPI, which is the Consumer Price Index, and is broken down to core CPI, which excludes food and energy. Last May, the CPI fell to almost zero overall and 1.2% excluding food and energy. However, since then, inflation has stabilized, with the year-over-year gain rising to 1.7% overall and 1.3% excluding food and energy as of February. Additionally, inflation signals such as oil are getting hotter, with the potential to boost inflation going forward. Stronger economic growth is likely to be accompanied by higher inflation, and the Fed sees this as transitory and expects to maintain its accommodative stance for years to come. Another point is that while inflation normally troughs after the end of a recession, things may be a little different this time around, with a high level of fiscal stimulus and the likelihood of an economic surge following the distribution of a vaccine. JP Morgan expects to see inflation to edge over 2% by the middle of 2021 and stay close to this pace into 2022. Early last year, the federal funds rate was slashed to a range of 0 to 0.25%. The Fed very aggressively supported markets by buying securities to add to its balance sheet. I've been talking about how the Fed adopted an average inflation targeting operating strategy where they are aiming for average inflation of above 2% for some time to make up for years of undershooting this target. In order to achieve this, they have pledged to hold the federal funds rate at its current target range until inflation is at 2% and on track to moderately exceed 2% for some time, and the economy is at maximum employment, possibly below 4%. With higher anticipated GDP for 2021 and given the new framework, it's fairly clear that modestly higher inflation won't prompt any policy adjustment this year. So what does this all mean for investing? For fixed income investments, the challenge is that the combination of very easy monetary policy and a recession left the 10-year Treasury yield close to 2%. Now, rising yields mean lower bond prices, illustrated by the Bloomberg Barclays U.S. Aggregate Index, which was down 3.4% for the first quarter. We also see that the purchasing of bonds by the Fed to protect other areas of the bond market have also compressed credit spreads. Essentially, that means investors are willing to pay more for bonds without as much consideration for their credit quality. While this has led to surprisingly strong returns from bonds in 2020, it severely limits the income stream provided by bonds going forward and heightens the risk of capital losses if and when the Federal Reserve becomes less dovish. Now, a year into the pandemic, the yield curve is steepening, meaning that the spread between long and short-term interest rates is widening, and this typically indicates stronger economic activity and rising inflation expectations, and thus higher interest rates. And it's for the right reasons, namely ongoing vaccinations, a declining number of coronavirus cases, and easy monetary policy. In the equity market, stock prices based on current forward price-earning ratios still hover at an alarmingly high level at 21.88 times earnings. Earnings are likely to continue to grow quickly in the year ahead, which should lead to some compression in PE, and as low interest rates continue, it supports a higher than normal PE ratio. Valuations look particularly high for mega-cap stocks and growth stocks, and it may become harder to justify these higher PEs if interest rates, corporate taxes, and wage pressures rise within the next few years. Because of this, we maintain a diversified exposure, including more value stocks while reducing weightings to some of the largest growth stocks. The challenge for investors from high PE ratios on stocks and low yields on bonds is illustrated here, where we see a typical 60% equity, 40% fixed income portfolio. The earnings yield on stocks, which is just the inverse of the PE ratio, should be a good predictor of future returns on equities. Bond yields should be a good predictor of the long-term return on bonds. The earnings coupon yield is constructed by adding 60% of the S&P 500 forward earnings yield to 40% of the yield on the Barclays Aggregate Bond Index. This is now close to a record low and suggests that returns on a plain vanilla 60-40 portfolio should be lower in the next few years. So we've been adjusting portfolios to contain a little bit more equity, including a broader exposure to non-US cyclicals and commodities. Looking at international equities, East Asia appears to have had more success in subduing COVID-19 than the United States, while progress in Europe in resolving the Brexit standoff could benefit the region in 2021. In addition, both emerging markets and developed country stocks outside of the United States are selling at some of the cheapest levels relative to their U.S. counterpart in the last 20 years. This, along with the potential for a strong global post-pandemic economic rebound, lower trade tensions, and the prospect of a lower dollar in the long run, make the case for a greater allocation to international equities. Within the equity market, does the current environment present more opportunity for value or growth stocks? While growth has outperformed in recent years, and most notably last year, value may do better over the next year or two. We see here that even after a good start to 2021, value still appears to remain cheap relative to growth compared to long-term averages. The right-hand side shows that earnings in value sectors in gray appear more likely to rise than growth in green in the robust economic recovery that we expect for the next year. I'm not saying that we should abandon growth stocks altogether, as the economy is likely to slow down to a much slower pace of economic growth later in 2022 and in 2023, and growth stocks have traditionally outperformed value stocks in this type of environment. This chart shows the total return by sector industry over 2 periods, between December 31st, 2019 through November 6, 2020 in gray, and since November 9th, 2020 in green. November 6th was chosen because it was the last business day before Pfizer's vaccine was revealed to have more than 90% efficacy against COVID-19. This chart shows how the winners and losers in the equities market have swapped roles since the first vaccine was announced. It's been encouraging to see energy, airlines, REITs, hotels, and banks revived. We'll conclude this quarter's economic review with a look at the matrix as of March 31st, 2021. U.S. small cap equity was the leader for the first quarter, up 12.7%, with real estate right behind it, 8.3%. Commodities made an impressive showing at 6.9%, where the asset class has been the lowest performer in the 14-year average. U.S. large cap equity up 6.2%, with international developed and emerging markets following next. And here's high yield and fixed income rounding out the bottom, down 1% and 3.4% respectively.